and he does think that the Fed will be pretty aggressive and focused on inflation. So markets should be aware of that. There's no changing that fact, at least not for right now. Chris, let's come to India, where we've seen a sharp correction as well. In your latest Read and Fear note, you say an interesting thing. You say the risk, the fact that Indian markets have been held up because of domestic inflows, and the risk to those domestic inflows is that about 50% of those flows came from retail investors putting money directly into markets and not via funds. Could you explain that?
Well, no, this is a point highlighted by my colleagues here in India, and I think it's a very valid point. So first of all, what's the remarkable development this year is the continuing pretty dramatic level of FII foreign selling of Indian equities, which by historic standards is as much as we've ever seen. But we've also seen this remarkable staying power of the inflows. But what's interesting, last fiscal year, about half of the flows were actually people investing directly in stocks, not through funds. So clearly, as time goes on and months pass, and on a 12-month rolling basis, people are no longer making gains on their investments, there's got to be a risk, if not a probability, that the domestic flows reduce. But having said that, it's remarkable up to now how resilient the Indian market's been. It's also explained by the fact that India has a very good macro story, in my view, right now on a 10-year view. We've got a lot of positives, of which, as I discussed last time, the key one is the property market having clearly turned up. On my trip this week, we're picking up more anecdotal evidence of a capex cycle coming. But this is a year where the Indian market would do very well to trade sideways, so long as the backdrop is Fed tightening, and also we have RBI tightening. Now, the RBI tightening dynamic is nothing like as dramatically negative as the Fed one, because the RBI is nothing like as behind the curve, though it is behind the curve. So it's good news they raised 50 basis points this week. But we have the other variables of the food and oil-driven inflation, of which the most dramatic is the potential. There's two real dramatic drivers, actually. There's the oil price, which I had a view that oil was going to 150 even before Ukraine because of the supply constraints caused by the attack by the political green lobby on fossil fuels. But clearly Ukraine has added a whole new dynamic in terms of fertilizers, effect on food prices, etc. So all this is a negative headwind, and the base case has to be that the Indian market corrects further. However, in my view, a big move up in oil, while it will be very negative in the short term, is not going to kill the Indian economy like it would have done historically. And as I said, my base case is that the Fed language changes before year end. I'm not expecting the Fed to be still tightening like this time next year. And therefore, it's just a question of watching out for that change in Fed language. If I had to guess at the timing of that change in Fed language, and it's purely a guess, it would be late third quarter.
Chris, if the S&P were to fall, as you said, at least 30%, say it falls 30%, what happens to the market here in India? I mean, the Nifty earnings for FY24 are estimated to be about 1,000 rupees. Let's say there is a 10% earnings cut based on all that is happening, right? So earnings estimates drop by 10%. Based on where the index is right now, that puts us at about 17.5, 18 times 1 year forward earnings. What is your sense in terms of where valuations and the index bottoms?
Well, Mike, in a world where the Fed keeps tightening and we have more of in my base case, we get on 30% or more, to me, the sort of level on the Nifty is 1,400, 14,500.
14,000, 14,500.
Yeah.
Okay, got that. Chris?
Now I'm just saying on a chart, that's on a chart where you look to have support. But it doesn't have to be that. I mean, it doesn't have to be that bad. It could be, if the domestic flows hold up, then there's a potential possible outcome where the Indian market just trades it's not my base case, but that the Indian market trades sideways. and the valuations are adjusted by the course of time.
Got it. Chris, you have cut your...
I mean, the 2 points to make is the inflation issue is much greater in America than India, one. And two, US equity market, well, India is an expensive market, but US equity market valuations are way more expensive, in my view, than India, most particularly if you look at valuations relative to sales.
Got it. Got it. Could you talk about what your are you changing your portfolio up here in India, the model portfolio up a little bit? For example, you've taken off some weight from HDFC Limited, you've added that into HDFC Bank. A couple of other changes.
Adjusted it
Yes.
from them. I've just adjusted. Nothing dramatic. Maybe later, but no, I'm perfectly comfortable with the long-term structural story in India. The risk, frankly, is just that the monetary tightening cycle, the higher rates delays the broader capex pickup. But all the evidence is the property recovery is underway. And India is a domestic demand-driven story, so that's good news. But history suggests that India stock market is highly influenced by moves on Wall Street.
Absolutely, absolutely.
Given the foreigners have sold, given the foreigners have sold so heavily. The foreigners will be looking to buy on any significant correction in India.
That's interesting. That's interesting. I think you had also suggested that
that level I identified. That level I identified on the Nifty, in my view, if you ever reach that level, would trigger a lot of foreign buying.
All right. Those levels that you were talking about, 14,500. Okay, got that.
Yeah.
Since you brought up the foreign selling point, right? There's been a fair bit of talk about what's going on, and I think we've discussed this before, that when people want to sell emerging markets, China being the big weight, it kind of drags down flows into other markets like India as well. And I think, I'm not sure, but did you highlight the fact that maybe it's time to look at emerging markets ex-China? I mean, would that happen? Would that come to fruition?
No, I'm not recommending it. I'm saying that is not my opinion. That's just an observation that this dialogue amongst the clients of investment managers, such as pension funds and endowments globally, there's a growing discussion over whether it's appropriate to have emerging market mandates ex-China. Originally, this discussion was driven by the view that China is such a big market, it merits a separate allocation on its own, and the rest of the emerging markets should be treated separately. But in the recent past, this discussion has taken another form, because many people are arguing that China is uninvestable, or that the Chinese government no longer likes the private sector. And there are people in the US who are arguing that people should not be investing in global emerging market mandates, including China, because China is perceived as the enemy. So this is a discussion underway. But the simple point is, if you have a global emerging market mandate excluding China, then the other markets become much statistically more significant in the benchmark, of which India would be one obvious beneficiary.
This may be a bit of a sweeping statement. You already said you're pretty bullish on some of the structural themes here. But manufacturing versus services, given all the commodity cost inflation that we are seeing, many are saying that maybe it's better to be on the services side rather than manufacturing over the next 12, 18 months. Would you agree?
Well, it depends. If the costs of all those higher input costs finally end up being passed on to the consumer, then I'm not sure that's the case. It really depends if they're able to pass the costs on, doesn't it?
No, it does. It does. Chris,
I think that's something we need to watch.
Yes, yes. And I think that's the reason why there is so much debate about who is pricing power in this environment, and of course the like.
Yeah.
Chris, it's a pleasure. Thank you very much for being here on this special show. It's always a pleasure hosting you here on CNBC TV 18.